Hey everyone, welcome to this session here on the XM Live Education platform Beginner Room. We are also live on YouTube right now for about 15 minutes. The topic of the day is Bitcoin cycles and liquidity dynamics. Okay. My name is Benjamin. If you are in the chat, feel free to interact, feel free to ask any question. It can be about Bitcoin or about crypto. And if there is no question right now, maybe I will start with the presentation. The idea about Bitcoin. The idea is that Bitcoin is really a hybrid asset, okay? There is various narrative around Bitcoin, one after the other. It's really not the same as the traditional assets, let's say. The various narrative evolved through the years, okay? It started at the mean of payment, created as a decentralized mean of payment. This is what was in the white paper of Bitcoin. Narrative evolved to a store of value, okay? Some people see it as a store of value. Some people see it only as a risk asset, okay? Which is basically a sort of leverage version of NASDAQ or tech, okay? And some see it just as a liquidity proxy, okay? So let's look at each narrative so you can make the idea for yourself, which narrative we are currently in with Bitcoin. The idea for the store of value is that Bitcoin is seen as a digital gold, okay, a hedge against currency debasement. We are in an era where most of the people are at least internet native, okay, they use internet for, I don't know, at least a decade, probably 20 to 25 years for most of the people, can be on the computer, on the phone, or whatever the support. The idea that you are online several hours per day, which means that an evolution of internet is logic that you should have a mean of payment or at least a store of value online for the people who go through some of their lives online. Which is like the idea around Bitcoin and how it evolved, being a store of value, having the possibility to store your money in a decentralized ledger and online. Okay, of course, this narrative grow more and more relevant as the inflation fears rise. Okay, because the idea is if there is high inflation, people are looking for store of value for assets which shouldn't really lose their value, okay, in order to protect their money. And those investors usually buy Bitcoin to hold for a long time, okay? They're not trading it. Then, of course, there is a narrative around Bitcoin being a risk asset, okay? Which the idea of this one is it's a beta to tech stocks. So either NASDAQ, leverage version of NASDAQ, or software indexed. The idea is it's following the broader markets, okay? When the liquidity is abundant, when the central banks are easing, the risk appetite is high, and people are looking for assets which are more risky, which are better to take in order to make bigger return, which is why it's often traded like a leveraged version of NASDAQ, okay? And some people see it as a liquidity proxy. The idea of this one is that basically Bitcoin is a sort of sponge, okay, reflecting the flow of global money. It expands when central banks are easing their monetary policy. And of course, it contracts during tightening cycle like 2022, 2018. And usually Bitcoin and crypto are way more reactive, okay? This is an asset class which is very dependent on emotion, on feelings, also very like a lot of algorithmic trading, which means it trade on news, on momentum. So when the price is starting to correct, it corrects fast and strong and there are a lot of emotion in the market. Again, if you are in the chat, whether it is on YouTube Live or on the XM Live Education platform here in the beginner room, feel free to ask any question about Bitcoin, about anything crypto related. Yeah, and if you have no question, we will go with the market cycle. The idea here is to explain how market cycles works, but for all assets, okay? We take Bitcoin because this is a really like symmetrical and nice asset to look at for the market cycle, but really it can work on a lot of other assets too. The idea is that a market cycle is the tendency of financial markets to move through recurring phases, okay? And those phases are driven by collective investor psychology, mass market behavior, okay? Macroeconomic factors, as I said, central banks tightening, easing, if there is a lot of inflation, if there is a lot of printing, all of those parameters have an influence on most of the assets at least. And of course, you have asset-specific fundamentals. In the case of Bitcoin, the halving, for example, okay? So we will explain the halving just later, like in 5 minutes. But yeah, some assets have very important news-driven asset-specific fundamentals. The usually market cycle always are divided into these 4 phases like this, okay? Accumulation, which is basically the wake-off accumulation here, schematic, which is basically where the smart money is entering. The prices are usually low, bottoming, sentiment very negative, almost apathetic because it's coming out of a bear market. The people who are buying like the sort of smart money, they are informed investors, okay? They are long-term believers. They see a sort of disconnection with current price and what they feel or estimated that the price should be in the next months to years. So this is why they are starting to accumulate on dips, on correction. Usually you have capitulation and despair in this phase of the market. When the accumulation is done, you have the markup, which is the start of the bull market, okay? You do have higher highs and higher lows, okay? The confidence is really growing. There is more and more investors and people talking about it, like media, institution. You see people talking about it on social media. The coverage on the media is starting to get bigger and bigger. This is why you have FOMO, which is fear of missing out, because people want to get into the trend because it's clearly bullish. So usually in this kind of trend, it starts with hope and optimism because finally you get out of this range, accumulation range. You have higher highs and higher lows, which is very encouraging. And then you have belief and thrill, okay? Because as the trend is going through, people are getting excited. But at the end of the trend of the bull market, you have the distribution, okay? The distribution can happen either in a volatile peak, like this one or this one, for example, or in a sideways range. Both are possible, okay? But the idea is that the people who bought the accumulation area are now up multiples and they want to take profit, okay? Maybe they feel that the price has gotten ahead of itself, way too high. Maybe sometimes they just made money, so they say that, okay, the trade is done. I've made like several excess of my money. I just want to take my money and go. Usually in the distribution area, you have sentiment which is overwhelmingly bullish and euphoric. Very, very bullish, very euphoric, okay? And the people who are selling in this area are the people who bought in the accumulation range. Usually you have euphoria and denial. Euphoria because people think that the trend will continue forever. Denial because you have the start of the first clues that maybe this is the end of the bull market and it's reversing, but people don't want to see it. Here, for example, you have a lower high, okay, lower low, and then you have the bear market. But people here would be in denial, thinking that price would continue again. And after the distribution, you have the markdown, okay, which is basically the bull market, lower highs, lower lows, like this, lower highs and lower lows, which is just a downtrend, a bear market. And the sentiment shift from denial to panic, fear, etc., because people realize that they won't see the prices they bought for a long time. Okay, so they basically get out at a loss. And then cycle repeats again because we are going into an accumulation phase. So this was to explain all different markets. But what's interesting, especially for Bitcoin, okay, is how the cycles are very, very similar. Okay, if we go look the timing for Bitcoin between this top to this top, we have 1,460 days. From this top to this top, 1,440 days. Okay, if we add this same amount of days, okay, so 1,430 days, let's say, to this top, it would give mid-October 2025, which is currently the all-time high at 126K. Okay, and since then, the price corrected to 60K here. Okay, so currently we do have like this cycle timing between tops. But what's interesting is that bottom to bottom too. Okay, this bottom to this bottom. Okay, so 2015 to 2019, same 1,430 days. And this bottom to this bottom, same 1,430 days. So if we assume that the cycle continues and we continue to have this sort of 1,430, 50 days between bottoms, if we add this amount of days here to the last bottom, it would basically give us early October 2026 as a potential bottom if the cycle continues, of course, which is a big if, okay? But until now, it's worked for the past 12 years, something like that. So usually in trading, we say that maybe it's not the same as it used to be, like history can't repeat, but usually history repeat until it's proven otherwise, okay? Historic patterns love to repeat themselves. What's interesting for Bitcoin is the why. Why could this like recurring cycle happen on Bitcoin? So the easiest answer, at least for the first 10 years of Bitcoin inception, is the halving. Okay, the idea of the halving, which is coded within like the Bitcoin code, is that people who are called miners, they basically are in charge of the network to make it work, to validate the transaction, to make it decentralized, etc. Okay, and in exchange of validating the transaction and make the network safe, they are getting paid some BTC. But every 4 years, okay, the number of Bitcoin distributed to those miners is divided by 2. For the people who are a bit doing a bit of math, you have a sort of log chart of the number of BTC in circulation. At the beginning, you have very, very few. First halving, you divide by 2, the number of BTC distributed, but you already distributed a lot of coins, and then by 2, and then by 2, etc. Which means that the impact of the halving is less and less important. But you can assume, let's assume that the demand is the same. You divide the supply by 2, which induce like a supply shock every 4 years, which is maybe the reason why Bitcoin early on has this sort of 4-year cycle due to the halving. Of course, the halving right now is still on a 4-year basis, And basically, it's less and less, his impact is less important because most of the Bitcoin are already in circulation. There is more than 90% of Bitcoin already in circulation. So if you divide by 2 the number of Bitcoin hitting the markets, the supply shock is not as big as it used to be early on in Bitcoin history. What's interesting is that this halving, which is on a 4-year cycle, okay, is basically also aligned with the liquidity cycles. Okay, if we look at here the liquidity in the past 12 years, like that,